Hi everyone, this video is about diversification. In school or college, we are often taught of the virtues of diversification, but there's a secret to doing it right, and that's that you don't allow diversification to become diversification. Welcome to YCG, where we help your capital grow so you can achieve your financial goals. If that's something that interests you, then hit that subscribe button and the bell notification so that you don't miss a thing. I'm Will Kruger, and I'm joined by Brian and Elliott again today. Hi guys.
Hey, how's it going?
So this is our wrap-up video where we discuss stocks versus all the other major asset classes we could invest in and why we believe stocks are the superior asset class. Feel free to watch this video first if you haven't watched the other videos. It'll be a good preview. But we would highly recommend watching the other videos though, as we discuss more details and go into more depth on each asset class. The other videos are in a playlist in the description below. Okay, so in 2004, Brian, you discovered this gem of a cartoon. It was drawn by Patrick Hardin. It's the big bad wolf financial advisor telling his three little pig clients that, quote, you could put it all into bricks, but I recommend diversifying your investment to include sticks and straw as a hedge. These stocks versus videos have all been about why we believe investing in stocks is similar to putting your money into bricks, and why we believe that the other asset classes are more like putting money into sticks and straw. Or in other words, sometimes diversification can become diversification. As we go through these various asset classes, pay close attention to which asset classes are productive, cash producing, as you'll notice this really seems to be what differentiates great long-term returns versus poor ones. All right, guys, so let's take a look at the first asset class, and that's of cash. Here, there's a chart that we're going to show here that shows the purchasing power of the US dollar since 1913, and you can see the huge and massive decline here. Any thoughts on cash as an asset class?
Yeah, so, cash is clearly the best investment for short-term spending needs. But the problem is that, printing money is the most politically expedient way to fund government spending. And so as a result, it's almost guaranteed to lose almost all of its value over time, as you can see in the chart you just showed, where, cash after inflation, the purchasing power of your cash has plummeted 97% over the past roughly 100 years, which is just staggering. So cash is great in the short term, but not in the long term.
All right, and so true. And so another asset class we've talked about is the asset class of gold, and gold being a store of wealth. Thoughts about gold as an asset class to invest in?
Yeah, so gold essentially acts as an alternative currency. And because it's harder to grow the gold supply than it is to print more paper money, gold's historically maintained its purchasing power over time, growing in price at roughly the same amount as inflation. The problem is that its value is much more volatile than paper currency, and so it can plummet or skyrocket unpredictably over decades at a time. Additionally, there's always the risk that some new alternative money rises to take its place, such as potentially crypto today.
Yeah, and obviously Bitcoin and other cryptocurrencies certainly are potentially new alternatives to gold, but I would say with higher variance. If they do become widely held, you could definitely see them growing in multiples as an investor. But if they don't, there's really no limit to the downside that we could see with cryptocurrencies. It's still a very new asset class, new money, and there are many people that really don't understand what it is. And certainly we've seen so much speculation recently with regards to cryptocurrencies as an asset class. So what about industrial commodities? I think this is a little bit different to gold because obviously they have productive uses. This chart is measuring a basket of commodities such as metal ores and textiles. As you can see, the real price has declined dramatically over time. So why is this?
Yeah, and Will, as you say that, it's productive, but all these asset classes we've talked about so far, none of them actually have productive cash flow.
True.
But yes, these commodities, they are productive in the sense that there's an actual use for it. But why has the real price been dramatically declining? Well, it's because human innovation has caused positive pressure on supply by increasing recyclability, lowering the cost of extraction, while innovation has also caused negative pressure on demand by creating more substitutes, which is improving production recipes so that they require less of these commodities. The same thing's likely occurring with carbon-based energy sources today as solar and other renewables get cheaper. And so really, no commodities are immune. Their real value declines much more slowly than cash, but that's about the best that can be said about them.
Well, let's move on to the asset class of bonds. So bonds appear to be better than all assets so far because they're the first asset we've shown that produces positive real returns over the very long term. You know, they've grown about 2% per year after inflation. Or if you take $1, it went up about 12 and a half times from 1900 to 2020. So when we look at bonds as an asset class, what are some thoughts we have there?
Yeah, so that's a decent return. Again, it's one of the first that's actually produced positive real returns, but there is a catch. So the problem is that you get taxed on bonds at the ordinary income rates. And so, pretty much every year, unless you have like a zero coupon bond or something. And so when you take taxes out, depending on the tax rate you use, your after-tax real return actually ends up being about zero or maybe even negative, meaning your entire return was eaten up by inflation and taxes. And in this next chart that we're showing, you can see that in some cases, in some countries, bond returns didn't even keep up with inflation and were very negative even before taxes. And the biggest examples of those are kind of hyperinflationary periods, such as in Germany after World War I, the Weimar Republic, those sorts of things.
Awesome. All right, so a new asset class, not necessarily a new asset class, some of them are very old, but collectibles is becoming a lot more popular, especially as wealth sloshes around the world and as governments print money. People are looking for different places to park their wealth, and collectibles is fast becoming something that people are looking to as a way to quickly take your wealth if they have to abandon their houses quickly and be able to do that in the form of collectibles. Let's take a look at this as an asset class. What do we take from this?
Yeah, so some collectibles have produced good long-term growth and purchasing power, and I would say it's especially the ones that have universal appeal and that are socially consumed, because those collectibles act as globally recognized markers of high social status, and therefore they must grow in value as wealth grows in order to maintain their exclusivity. And some of these on this chart, such as wine, violins, art, all of those, and even more recently, luxury handbags are examples of these types of goods. However, the problem is that collectibles can be dangerous because many categories that were once popular have now fallen out of favor or turned out to be more faddish than people believed at the time. And some archetypal examples are tulip bulbs and Beanie Babies.
Love that chart. Super interesting to see the performance of those different asset classes. One asset class that I think everyone really has a familiarity with is real estate. So let's talk about real estate as an asset class and what are our thoughts there?
Well, on the surface, housing prices appear to slightly beat inflation, which one would think would at least keep pace with inflation, since land today is still land tomorrow. And you think you could eke out even a real return and slightly beat inflation if land becomes scarce. But by the time you strip out property taxes and maintenance, you're actually very likely at a negative real return. And this makes sense because in many places, land is actually not scarce. And even in places where it is, the actual home that you've built on that land is depreciating because innovation reduces build costs over time, and because there's normal depreciation from wear and tear on the house. But of course, you have to live somewhere. But we think it's better to not think of your house as an investment and more as a living expense, because the opportunity cost is you could potentially make a lot more money renting it out elsewhere or reinvesting elsewhere.
Right. Yeah. Great points, Brian. And then the other category is sort of cash producing residential or commercial real estate. And that can actually be great. And we'd actually say it's our second favorite asset class. But keep in mind that it is illiquid, and you have to borrow a lot of money to get your returns. And that leverage increases your risk in a severe downturn. Additionally, most real estate opportunities require huge investments, which can make diversification a challenge, which opens you up to the influence of good or bad luck, depending on whether you invested in real estate, for example, in Austin, where we live, or Detroit. I would also point out that two of the risks, illiquidity and lack of diversification, have been solved in recent decades by the ability to invest in REITs, so real estate investment trusts that pool a bunch of different real estate together. But unfortunately, the high leverage issue still exists, which is a huge issue because there's potential blow-up risk, and you just never want to open your portfolio up to massive blow-up risk.
All right, so we've talked about the sticks and straw. Let's get to the bricks. Stocks as an asset class. Clearly, the data is pretty evident, but let's talk about stocks as a way to store and grow your wealth in the long term.
Well, stocks, in our view, are by far the best, and as you say, historical evidence suggests as such. And as you mentioned at the beginning of this video, they're a productive asset that produces cash flow, which helps with that. And it may not seem much to have equities compound at about 6.5% after inflation, but it really adds up. As you can see here, $1 has multiplied 2,291 times from 1900 to 1920. And nothing that we've shown is even compared to this. Only cash-producing real estate maybe would if we could get the data on it. But after stripping out inflation, you see these enormous returns. Imagine if you did it even on a nominal basis. I don't know, Elliott, what is it, like $1's gone to 60,000 times or something like that?
Yeah, so something like that. 60,000 is what I have in my memory.
Yeah, it's crazy. So it's by far better than any of the other categories, with the possible exception of leveraged cash-producing real estate. But it's too difficult to get that data due to the private illiquid nature. Additionally, stocks have plenty of diversification benefits because it's much easier than most asset classes to construct a portfolio that's diversified by geography, industry, product category, and macroeconomic factors.
Yeah, great points. And I really think the moral of the story here is we think the best approach is just to ride the stock market wave, right? And here at YCG, instead of just owning the whole stock market, we believe the best way to diversify is to own a diversified collection of global champions with pricing power, long-term volume growth opportunities, ownership-minded management teams, and businesses that have conservative balance sheets, which we believe really stacks the odds even more in your favor. Well, thanks for tuning in today for this episode of Common Sense. If you have any other comments, please leave them below and check out our other videos. Thanks for watching today.